My name is Varun, and I am the lead of Quantra content team and research team. So today's lecture is about market microstructure, and we'll be discussing about the basics of market microstructure in this lecture, and also we'll look at some statistical concepts or techniques involved in how high frequency trading is done, and then we'll look at one strategy on high frequency trading. Okay, so let us start this lecture. So before we go ahead, I just want to give you some basic historical background about HFT trading and other things. So before 1999, the statistical techniques that were used for analysis of data and other things was quite different, because the amount of data at the time was collected manually, right? But now, as you can see with the internet, you can collect a ton of data very fast, and we need to analyze it very fast. So the game has basically changed, and the techniques that were used. Yes, Mank, you are not able to hear? Hello, everyone, online participants, can you guys hear me? I think, Mank, you are not able to hear me. Probably you should just check the connectivity, because rest of the team can hear me apparently. So as I was saying, the techniques after 1999 were mostly very different, you can say, from that were employed earlier. So these changes were brought about by a very good and excellent paper written by Mr. Robert Engel. So he was given Nobel Prize for it. And have you guys had the lecture on Arima and Garch? Arima and Garch lecture, autoregressive moving average. Okay, so you will have that lecture later probably. So that is one of the key concepts of trading, or you can say the autoregressive part, where the time series or the data that you have, stock data, is correlated with its past data. That is, you have some trending or non-trending information. So how do you extract that? That is one of the main concepts or theories that was discussed in this paper by Robert Engel. So just to give you something, this is Robert Engel, and he was given Nobel Prize for this. So he was one of the first people to have come up with this idea. So again, going back, when we go into HFT trading, okay, so there is something called as order book. How many of you know what an order book is? If you don't know, it's fine. Just if you say yes, just say yes if you know what an order book is. Order book. This one, order book. Okay, so there are a few guys who don't know what an order book is. I'll just explain what it is. So when you have an exchange receives orders from many players, right? So there are people all over the place, and you have brokerages, you have institutional bankers, you have individual traders. There are so many guys who place orders. I made a sum up of the lecture at the beginning. So I just said that the lecture would consist of some basics of statistics, high frequency trading, and one high frequency trading strategy. So we'll be covering basics of HFT and some more theory about HFT, and one research paper about HFT, and then applying that HFT in a Excel sheet. Is that fine? That, hope you have got this gist. Okay. So coming back to order book. So all the orders that come into the exchange are placed or collated into a single sheet of paper, or you can say an order book, or it can be an Excel sheet, or it can just be a raw format. So this order book will have timestamp, or the time at which the order has come into the exchange, and it will have different features. For example, like, is that an order? Is it a new order, or is it an old order that is being modified or cancelled, or is it an execution order, that is, you directly are hitting the market for a trade? Or it will tell you whether it is a buy or a sell order, and it will tell you the amount of volume that is there, and it will tell you the price at which it is going to be traded, that order is. So all this information about a single order is collected and it is stored in the order book. So this order book can be of two types. That is, if you have some brokerage account, okay, like Interactive Brokers, okay, or when you connect to it and you request data from it, so you get probably data at a frequency of once in 3 seconds or thrice in 1 second or something like that, right? So you see that the data keeps getting updated very frequently. So the question is, when you see the data, there are two types of data. One that just shows you uh, bid and ask, the best bid and the best ask, and the last traded price. And this is known as the L1 data or the level 1 quotes, like level 1 quotes. And when you see a price ladder or the depth of the market, you see many other prices which are not exactly the best bid and best price. You will see much beyond that, right? The top 5 best bids and top 5 best ask. This is known as the level 2 quotes. Okay. So so everyone clear about what an order book is and what type of data we have, L1 and L2, what they are? Online participants, if you still have any doubts, please let me know. Is L1 clear? You understood what L1 is, what L2 is, what order book is? Cool. So I'll go ahead. So when we, okay, L1 data will have only best bid and best ask, right? And L2 data will have top 5 best bids and top 5 best ask. It's just that L2 data is more robust. You'll have a lot more data. So when you have an exchange trading, when you are trading on an exchange, you not only get the best bid and best ask. You know best bid and best ask, Sriram? So if you just have that information from the exchange, that means you are having L1 data. If the exchange is giving you the top 5 best bids and top 5 best asks, then it is L2 data or level 2 data. Is it clear? Okay, cool. So let us try to make a small distinction between the technical indicators that you have used till now and the type of trading strategy that we are going to use up right now. So most of the technical strategies or technical indicators that we use, they are backward looking in time, in the sense that we use past data to make a prediction about the future, right? We take the past behavior like simple moving average or the past 14 period data for a RSI or something like that, right? But in HFT trading, we take only the current data, the current state, irrespective of what has happened in the past few seconds or whatever. We just take what is the exact situation right now. Okay, Jigam, you're saying, sir, NSE gives whole order book to few. What is that called? Okay, whole order book in the sense? You mean level 2 data or the entire 50 up to depth of 50? I think there are different levels depending on the exchange. Every exchange has different levels of order book. As you say, probably NSE gives the entire order book. There are exchanges like ICE, Intercontinental Exchange, they also give the entire order book. But yeah, every order is that goes into the exchange. But if its depth is much more deeper, then there is no point in actually getting the data if you are doing algorithmic trading. So generally people avoid that. Yeah, but exchanges do provide the entire data. It is probably a different type of L2 data. So the definition of L2 changes from exchange to exchange and brokerage to brokerage. So one broker defines it as top 5, another defines it as top 20. So in NSE you have an option to get top 20 and best bid and best ask also. Further, they will charge you separately. And there is one more package probably where you can get the entire order book as you're suggesting, and it will definitely cost a lot more. So that industry definition stands for L1 and L2. L1 is the best bid and best ask, and L2 is anything that is much more than that. And typically L2 stands for top 5. Okay, Tad, you're saying how much does it cost join. I don't get you that. Which session by call? You mean the current one? The market microstructure lecture. I don't know how you can join it by call. I really don't know that. Sorry. Probably you can contact the support team if the connectivity is not good. Or you can view the lecture afterwards. Are you asking about the order book or are you asking about the session tab? I am not able to understand. Okay. Just a second, guys. So anyway, so I was discussing about historical and forward-looking data. So this HFT data, we take the current market situation. We'll just read the order book. That is how the bid and ask are standing, how far is the ask from the bid or something like that. We take some small metrics and calculate the exact situation in the market, how the order book is placed right now, and make a prediction for the future. So this is very different from what we do earlier. Earlier we used indicators that are dependent on the past data, taking averages and all. Now we don't do that. We'll see how to apply this high frequency trading strategy or historical type or forward looking model at the end of this lecture. So okay, so moving forward, we'll have some interesting concepts to discuss. So the first concept is about dark pools. So some of you might have heard, some may not have. So I will just briefly tell you what dark pool is. Dark pool is like an exchange, okay, that is accessible to everyone, even a single trader or a investment banker or in some kind of brokerage firm. Anybody can access it. But the reason why it is called a dark pool is you will not get the data about the amount of volume that is there in the order, okay, or the price at which is getting traded. The purpose of doing this is to avoid any kind of price manipulation. So whoever goes or places an order in a dark pool, they will be placing only orders based on their understanding of the market, okay, not to see how others are going to react or try to outsmart the other guy. So if I want to trade in a dark pool, I'll have to mention the price and the volume that I want to trade, and I won't be getting any data like where the others are standing in the order book. So you won't see the depth of the market. So this kind of a dark pool, although it is not there in India or it is not legal in India, in US you have dark pools. In US markets you can trade using dark pools. You can place your orders on the dark pools and get your data. The purpose or the advantage of using this dark pool is it doesn't have any transparency, but it will guarantee you that your order will get executed even if the volume is huge. So let us say I'm a big player and I have some 10,000 lots, okay, and I want to trade in the market. If I go directly and place 10,000 lots in the market, it will definitely move the market away from me, whether it is buy side or sell side. Dark pool is something like disclosed order in NSE. I think disclosed order, you mean iceberg type of orders where you place a huge volume but only small amount is seen, right? So yeah, that is not it. Here you won't see anything. There are no orders anywhere. That is the difference. So here the entire exchange is like blank. And also you don't get any data. So you just have to place your order and just hope that you will get a fill. And if you do get a fill, you will get informed. So that's it. Can you see the current price in the dark pool? Yes, if you get an order fill, then it is, and mostly the dark pool's price is very much correlated to the current price in the market. So very close to it, but we exactly don't know. some dark pools give out the last traded price and some don't. So again, it varies from dark pool to dark pool. So I cannot say that they all give out their current price, but you do get it sometimes in some places. Okay. When a trade is executed, does the volume change? Volume is not seen at all. Your volume, you only know your volume. That is, you have a volume, you know how much it is, and you know how much has been executed. That's it. You don't know about any other volume that is in the exchange. Is it a block deal, window, or terminal? I think block deal is done over the counter, I guess, right? Not in electronically. That is a small difference between these two. Total volume change in the exchange? No, you don't get the total volume change in the exchange. No. You can get your own data information. I mean your own orders information. Anything else? Online participants? Okay, so you can't track the volume. No, you can't. You can't track who is placing how much volume. No, Akshay, you won't be getting the volume traded and all. But they do publish probably quarterly reports and the amount of volume that is getting traded in their, to the shareholders and all. So from that you can get to know anyway. So, and again, some dark pools may publish their volume data, daily volume data at the end of the day, but in general, it is not a practice. So going back to multiple venues. So in India, we have two exchanges like NSE and BSE, but in US, you have 19 exchanges. So when you make an order book, you need to have all the data, that is all the volumes data or the data of the volume that is present in every exchange. So when you are executing on multiple exchanges at the same time, you need to understand what is the exact situation in the market and where in which exchange you would be getting a best possible price for execution. Right? There will be some discrepancy in the best order and best bid and best ask of two different exchanges all the time. So keeping that in mind, when we execute orders, especially in multiple exchanges like in US and UK, you'll definitely have a consolidated order book. A consolidated order book is when all the volumes are taken from all the exchanges possible for that particular entity. Like you have a stock that is traded on 4 exchanges. So you get all the data from the 4 exchanges, all entire order book data from the 4 exchanges and build your own order book. Okay. This is called a consolidated order book. This is how we actually handle the issue of multiple venues. That is when you have multiple venues where you can execute your order. And coming to the multiple order types that we have, I think you are aware of iceberg order. Some of you have already mentioned, and you guys are aware of fill or kill order, right? And I think there are some OCO orders, right? Conditional orders. That is when you get a fill, then the stop loss will be removed, and if similarly if your stop loss is triggered, then your take profit order will be removed. So that is one type of conditional order. And we have tailing orders that follow the last traded price. So those type of different orders we have. I'm just trying to revise whatever we have learned so far. Which these are the different types of orders that we use. Yes, cover order with stop loss, without stop loss. So there are many ways in which you can execute. So the complexity of the algorithm increases as you take all these things into account. As you can see, there are already a lot of possibilities or execution preference that can happen over one algorithm to algorithm. So if you just change the order behavior, your algorithm's performance will definitely change. And even if you trade a simple strategy with market orders and with limit orders, your net result is going to change, right? So the type of order plays a massive difference. I mean, it plays a big role. So again, coming back to spoofing, Spoofing. Okay, let me ask you guys this question. Do you guys know what spoofing is? Or is it legal or illegal? And if it is not legal, then why is it not? Okay, so spoofing is basically when you cheat or rather game other people into giving whatever you want. So let us say that I have no intention of actually buying something, but I place a huge volume on the bid. So as soon as I do that, best bid, the market will move slightly up, right? When the market moves higher, I go and hit the best bid, okay? And once I remove the big volume from the bid side, again the market will come down, and then I take a fill on the lower side. So people do this. They keep. I'll just let me show something. Okay, this is one screenshot that I have taken of one exchange, and this is Euro USD, I guess. If you see, the best bid here is. Can you guys see what is the best bid and best ask? Online participants, the best bid here is 25 volume at 1.3353, right? And the best ask here is 15 lots at 1.3356, right? Yes, excellent, Kalpesh. So you can see that there is a, what do you say, a margin of 3 ticks between the best bid and best ask, right? So let us say that now I place 500 lots. Okay, that's a huge amount. If you see, the average volume here is about 25 to 30 on the bid and ask side. If I place 500 lots on the buy side, that is at 1.3353, I place 500 on top of this 25. Okay, what will happen? What do you think will happen? Kalpesh, anyone? Akshay, offer will be lifted. Okay, or let us just say that the order book will move slightly to the upside. We can't say that you'll get a fill on the offer side. Yes, the market will definitely go up because the volume is huge compared to what is existing in the market. So let us say that as Tyagarajan suggested, if I put an offer on 1.3355, okay, here where it is actually empty now, will I get a fill? Most likely I will get a fill, right? Here I'll put an offer and I'll put 500 lots here. So someone will go and get hit it, so I'll most likely get a fill, right? And once I get a fill here on the ask, I'll pull my bid from here. Okay. Once I pull the bid, what will happen? The prices will again come down. Then what I'll do, I'll just wait for someone to place an offer slightly below this 1.3355 and I'll go and hit it. So this is basically known as gaming, where you try to move the market in your favor by a small amount, like 1 or 2 ticks, take a fill, then pull it off. And this is illegal. This is illegal across all the countries. You cannot do this, and if you do this, you are going to probably get fined heavily. So when you create an algorithm, you have to keep this in mind that your algorithm doesn't actually end up doing spoofing. All clear? Online participants, you guys understood what I'm trying to say? What spoofing is, how some people game you, or your algorithm should be robust enough to handle gaming by others. Kalpesh, Terence Hui, he is spoofing legal in crypto markets. You're talking about the regularized cryptos or the unregularized ones? Regularized ones are those that are provided by ICE, regularized exchanges, I mean, that are monitored. Yes, Nathaniel, I'll explain. So here, coming back to spoofing again, here you can see that the average volume is around 30 lots, right? and here also it is approximately 30 lots. If I put 500 here, and before I put 500 here, I actually put, sorry, if I put 5 lots, let us say at 1.3355, I put 5 lots. I have put 5 lots, and then I placed 500 here. Okay, then the market will move up, or someone who is very eager to buy the market, they'll go and hit my 5 lots. And as soon as I get a fill, I'll pull the entire bid side order. That is, I'll pull my 500 from 1.3353. So this will definitely spook the market, and it will move slowly into the downside, because they will want to test whether this volume that is there here at 1.33, whether it is real, or 1.3353, whether it is real or not. So what I'll do is I'll take a fill here at 1.3355, and once I move the 500 lots, I'll put 5 lots here, 1.3354. People will come and test it, and I'll get a fill. So I basically make one tick profit. Yes, that's a very good question. So when I put 500 lots and someone tries to test me and they hit the 500 lots, I'll have to take the fill. That is a huge risk. So generally when people do spoofing, it is like for a very, very short amount of time. Okay, whenever I put a best bid order, there is some order which comes before it. Is that what you're saying? So that is also it's probably called as market making. So market makers, what they do is they try to provide best volatility or liquidity into the market. So either it could be spoofing or it could be genuine market making. So if people feel that the spread is huge, and since you have put your order, right, so they'll stand ahead of you to take more liquidity get more liquidity into the market. So this is done by liquidity providers in the market and authorized market makers. So they do it, and this is not spoofing, because usually the volume that comes ahead, as you're suggesting, in front of you is very less, 1 or 2 lots, and they do take a hit. That is, if you can hit them before they pull out, they'll give you a fill, and they keep doing this. They keep providing liquidity on both the sides, both bid and ask, small amount. Is it clear? So let us move ahead. Okay, so coming back to our modeling approach, or the model that we are going to see in this lecture, it is basically a Markov type model. Markov means that whatever has happened in the past doesn't have any effect on the current state, or rather whatever is happening in the past will not have any effect in the future. So it says that whatever is there right now, that is all that matters. So in an essence, past data doesn't matter, current data is all that matters, and the past data and the current data are independent of each other. So Marcelo, you're saying spoofing is like to put order in opposite side of the book. Yes, you're actually masking your intention. Your intention is actually to sell in the market, but you put a huge volume on the buy side, and you don't have any intention of buying. So it is about what you actually want and what you're trying to show. Online participants, understood? So again, Markov type models are basically dependent on the current state and not on the past. So we'll see how that happens in the example that we take up later. So we don't use the past data to make a big analysis, or we don't use the past 14 days data for 14 minutes or 14 seconds data. We take the order book's behavior for a long amount of time, but not today's, and we just calculate based on that. So we'll again get to that. So when we, as you can see, the amount of data that is coming in and going out on the order book, like the best bid and best ask, is huge. Okay, is it illegal if the tick size is small? That's a good question, Nathaniel. But if your tick size is small and your volume is huge, right? Huge compared to what is standing in the market, right? then it is definitely legal. Even if the tick size is small and you have no intention of actually taking the fill. You keep putting 500 lots, but you have actually never took fill for the 500 lots. That means that you have no intention of taking fill, right? You are using that 500 lots to take fill on the other side. Then you are definitely doing spoofing. Even if the tick size is very, very small, it doesn't matter. We are still spoofing. Is it clear? Okay. So again, we'll discuss one more research paper at the end of the lecture. Okay, and that will be based on Poisson's distribution, or rather Poisson's arrival rates. So we'll look into that at the end of the lecture. So we'll move ahead right now. So you guys understood what Markov type model is? We don't take the past data, we only take the current data, right? So when we are building such a model where there are a lot of things happening, let us say that again we'll go back to this example. Here let us say on top of this 25, if I put another 200 lots, okay, what do you think will happen? Will the market move up or will it move down? Just give the probability. I mean, I'm not asking for a definitive answer because we don't know, now anything can happen, but probabilistically speaking, what do you think will happen? If I put a huge volume on the buy side, will it go up or will it go down? Online participants, good. Okay, Kalpesh, go up. Akshay, go up, up, up. Okay, cool. So your guess is that it is going to go up. But okay, let me show you another thing. Let us say this is how there are two markets, okay, and you have two different order books like this. And let us say that I have huge volume on the ask side and I have huge volume on the bid side, and compare that with this. Okay, now tell me, just by looking at this one single order book, can you make a prediction? Just because there is a 200 lots here doesn't mean this is going to go up if there is another market also existing which has another order book. You are getting my point? Just by looking at one market and one order book, you cannot say it is going to go up even if the volume is huge. Yes, you cannot predict. By looking at half of information, you cannot make a prediction. So when you have the complete data, only then you can make a prediction. Online participants, did I make it clear? Are you able to understand? Okay, if you're saying doesn't it depend on the market you're trading? Whichever market you're trading, if that particular underlying asset is being traded in multiple exchanges, right, with multiple order books, then you have to take all the order book information and then only make a prediction. If you take one single exchange data, then the information will be incomplete. Iftikhar, is it clear? Sambit, understood? Okay, fine. So we have to check NSE and BSE order book. Yes, if that particular stock or whatever underlying asset is, if it is getting traded in two exchanges, then you definitely have to check both the order books. Okay, Rohit, you are saying but the participants of the exchange would vary, is it? Is that what you're saying? Participant of the exchange would still be influenced. Yeah, it will be influenced, but those participants who are actually influenced are also probably having half of the information. So whoever actually has the complete picture, complete order book, they will definitely not be interested in buying when there is a huge offer on one exchange and there is a huge bid on one exchange. It basically tells you cannot make any realistic prediction, right? Okay, Kapil, we normally get consolidated order book best quotes. No, we don't. We don't. We only get for whatever order book the brokerage is giving to you, right? Mostly what the brokerages do is they give whatever data they have. Like if you have zero there, they have an order book of their own, right? Where different traders are placing orders, they give you that data. Or you will have to subscribe from the exchange from the data. Then you will get all the data that is going to the exchange, okay? And all the orders that are being placed on the exchange by different vendors, brokers, and whatever. Then you have the consolidated order book for that one single exchange. And similarly, you'll have to get a consolidated order book for the other exchange also. So you need to have complete order book information of both the exchanges. Is it clear, Kapil? Okay, good, awesome. Okay, so coming back to making a prediction. So let us say that you have an L1 data. Okay, Kalpesh, taking this into account with different volumes and different prices for the same stock, you are uh, you are likely to get arbitrage situation. Yes, that is what high frequency trading mostly does is about. Whatever arbitrage opportunities you get because of the mispricing or different pricing in two different exchanges, this is called an intra exchange arbitrage. That is, you have two exchanges and within the exchanges you are trying to make an arbitrage, or you might trying to make a small amount of profit with 2-3 ticks, probably with small volume. And people do it. People do it. Any more questions, online participants, in class participant? So Terence, so isn't any kind of microstructure strategy impractical for reader? No, it's not at all impractical. Many people do it. You just have to co-locate your server. So co-location in the sense you go to the exchange and you place your server along with the all the other servers within the exchange compound, like probably in the same floor or some the floor above, very close to the exchange within the exchange limitations, and you reduce the amount of time it takes for the data to travel to you. So when you place your server very close, the order book data is directly calculated or skimmed through very fast by the server and made a prediction very fast and it places an order. And similarly, when you have multiple exchanges, you will have to take co-location at multiple facilities to execute orders at all the places at the same time. So it's not impractical. People do it. But I understand what you're trying to say. It is very difficult to keep the amount of time that is needed for the data to travel from one place to another place. That you will have to keep in mind. That is true. So if you are implying that, then time is a huge constraint. That is why you see that in high frequency trading, it's no longer about who is going to make the prediction. It is about who. So time is the biggest constraint, and it's not the predictability of the algorithm. So for example, there is this firm called Virtu. So they are the biggest market makers in US markets, and these guys have a profitability or the accuracy of 51%. Okay, so you can see that just by 51% of accuracy, they are still profitable with 800 million turnover. So their profit last couple of years probably was very huge, around 800 million. So you can check it out on the internet. So the amount of predictability or accuracy is low, but if you are able to place the orders before everyone else, then yes, you can make a lot of money. And also if you are making the market or you are involved in market making activities, then the exchange is bound to give you some kind of discount or a rebate. So what they will do is They will reduce the transaction cost for you, since you are not doing any kind of speculation. You are just providing liquidity to the market. You will be standing on the bid and ask continuously, so that whoever actually hits the market, they are most likely to hit you. So you are providing liquidity consistently, so you will be making money. Online participants understood till now? Any questions? Fine, so I'll move ahead. So when we build a high frequency trading model where you have L1 or L2 data, right? So when there are so much of movement and there is so much of price action happening, where there is a lot of cancelled orders or orders that are being modified or new orders coming in and going out, these events keep happening continuously, right? So when there is so much of activity happening, how can one actually predict what is going to happen next? Like, even if it is L1 data, you have very less data, and if it is L2, there is too much of data. Like, there is too much of movement happening in the market, within and without. So how do you actually understand what is happening in the market when you see that there are lots of events happening in a given, in 1 second you have at least 50-60 ticks or movements happening in the market? You guys know what a tick is? One tick. Online participants, if you don't know what a tick is, please let me know, I'll explain. Okay, Kapil, minimum change. Okay, so a tick is defined in two ways. One is tick movement. That is the minimum change or the minimum movement that can happen in a market. That is one tick movement, right? And a tick is also defined as one singular event. So in some places you will find two different literature. So whenever there is a small event happening in the market, that is order getting changed, or one order getting cancelled or removed from the market, or one order, new order coming into the market. So all these are events, and all these can be counted as ticks. Tejas, Mohammed, Kapil, are you guys able to understand what a tick is? Tick movement is different and a tick is different. Okay, so any event that happens, a singular movement, can be counted as a tick movement. Okay, so how do you actually know that your algorithm is doing well, or is it profitable or not? Is it going to be profitable or not? That would depend on the probability of your prediction. If you are able to make a prediction with at least 50% accuracy using the order book data, then you can say that your order book has some kind of information in it. That is, with 52% probability, you can say that the market is going to go up in certain situation. So you are saying that your order book has yielded you some information, right? That is slightly more than a 50-50 odds of making a prediction. So you can say that there is some information content in the order book. If suppose your algorithm is not able to make any prediction, right, then you cannot say definitively that your order book is useful. So in such a case, it is most likely that your order book is not complete. That is, it is not a consolidated order book. There is a very good chance that if your probability and profitability are not matching, then your order book will not be consolidated. That means there are some volumes and some information that are missing. Okay, so when you actually encounter such discrepancies, then you should try to solve them with the help of uh, getting more data into the picture, which will clear it up. Okay, Krishna, you're saying, can we judge a buying from a bid and ask data? Yeah, you can. Definitely, yes. The exchange does give that information. You can know where the order is getting placed, where it is hit, whether it is a bid or it is a ask. You can definitely extract all that information. Rohit, so typically an average market maker has 50% of probability of making profit since they are always on the bid and ask. So that is a good question, Rohit. So let us say that the market is trending to the upside. So the guy is placing bid and ask, but only his ask is getting hit and the market is moving up. Do you think he will still make profit? He won't. So as long as the market is choppy, then they will make money. If it is trending or highly volatile, no, they won't. So they lose money and they will make money. They make money when there is low, you can say very less volatility. The market is range bound, then they make money. Understood? Rohit, are you able to understand what I'm trying to say? Okay, good. So, sorry. Okay, so this is just a brief introduction. I think we have already spoken about the probability and information content. So if your probability less, and again your profitability is also less, then it is fine. If your probability is more, probability of prediction is more, or the probability that your algorithm makes that, okay, there is a 70% chance that the market will go up, but you're actually making losses every time it makes such a prediction. That means that your consolidated order book is incorrect and you need to get more data, or there is some kind of misbehavior happening in the market. So again, this is the HFT algo that I'm going to discuss about in this lecture. So any questions till now? Anything that you want me to answer again? Anything I have missed out? Online participants. Okay. Formula on the left. Last slide. Last slide. This one. This one. We'll get to that. We are still not there yet. We are still in the this one. Okay. This is basically the calculation of probability. So normally when your order book is not useful, okay, you will get a probability of 50%. That is, you cannot make any prediction whether it is going to go up or down. If I say there is 60% probability of market going up, then you can probably take long, right? But if I say it is 50%, can you take long? You can't. So if in this case, if the P denotes the probability of any order book of your sorry, algorithmic model, and the probability that the model is correct is also pretty good, and your prediction is basically saying that there is a very good chance that market is going to go up, and given the order book, okay, given the current state of the order book, if your probability of prediction is equal to 0.5, then there is no information that you can draw or you can make any reasonable prediction. So if your probability given a particular order book information, if it is more than that, more than 50%, then you can say it is informative. Okay. Is it clear, Akshay? Okay. Gautam, when we talk about order book, is it the order book we see on the exchange, or are we creating our own simulation of an order book? Okay. So as I said earlier, every exchange has its own order book, right? And there are multiple exchanges, then you need to get multiple order books from all the exchanges and create your own order book, right, to make a prediction. That is called a consolidated order book. So you need to have a consolidated order book to make a prediction. Is it clear, Gautam? Have I answered your question? Okay, Jigam, you want me to repeat what is there on the slide, right? So coming back to the slide here, P stands for probability, and if P is more than 0.5, then it means that the probability that your model is making a prediction for moving up or down is slightly more than 0.5. So you can take, or you can rather, what do you say, that information and trade. But if it is equal to 0.5, that means there is equal probability of going up and down. Excuse me. If it is equal probability of going up and down, it is not informative, right? The order book status here, OB stands for order book. So given an order book, the probability of market going up, if it is equal to 0.5, then you cannot do anything, right? So the slide here is basically trying to say that unless the order book gives certain probability which is higher than 0.5 for a moment, you cannot really use it in any algorithmic process. You will see it once we go to the construction of high frequency model. So when you see the probability calculation, you will understand what is actually happening. Okay. Nathaniel, you're saying, don't we take news flow when considering probability? No. In this model, no, we won't be taking news flow. But you could build a model, but I haven't read about any such news flow model till now. But you can try. It would be really interesting. Okay, Madhavan, is the order book we see through our brokers specific to that broker only, or does it reflect the order book in exchange? That is a good question. It is mostly the broker. So unless you subscribe, the exchange will not give you the entire order book, right? So if you subscribe, you will have to pay. Once you pay, the exchange gives you the rights to see all the order book information that it has, okay, that is being placed by other brokers. So you just think about it. How can your broker fetch information about other brokers? They can't do it, right? Unless the exchange verifies it to them, and exchange gives them that right. So if exchange is giving the data for free to everyone, then it is fine. But in most cases, exchange don't do that. They don't give everybody's order book. You'll have to buy that information and then use it to build your own order book. So broker can give you whatever information they have about their clients. Is it clear, Madhavan? Okay, so moving on. Okay, let us open this Excel sheet. I'll just okay, so you guys have this Excel sheet, please open it. Unknown participants. Okay, Krishna, you are saying, as per my experience, NEET places order directly to the exchange, and in Odin it goes to the broker and goes to the exchanges. Probably, I am not. I think NEET, what you're saying is true, but Odin, I don't know. I'll have to get back to you on this. Even if you are correct, that means that you'll have to take that, complexity of the model into account. Like which type of order placement criteria are you using? Right, so only then you can actually place an order. So the probability of market moving in a certain direction is the output that our algo gives on going through the order book. Yes, Rohit, that is correct, absolutely correct. Is it the MMT03 zip file? Yes, this lecture is MMT03, right? Market microstructure, that is the code for the lecture. If you have already downloaded it, or else you do one thing, you guys just look at what I'm trying to show you, because you will have only the first 3 or 4 pages sorry, columns. Online participants, you just look at my screen, I'll explain it to you, then you can open your own Excel sheet, because the Excel sheet size, as you can see, is huge. So your system might get stuck or hang. So Rohit, you're saying in that case, an order book being informative is contingent on the accuracy of my algo. Yes, the same order book can be informative. No. So the thing is, if your order book is informative and you are able to extract information about the small order book, like what you are saying is, let us say that your broker is giving you the order book data. Let us say that, okay? And if you have created a model that is working on the past, like back tested it for the past 2 years, and it is working fine, but there is no guarantee that the behavior will hold for the next few uh, months or so. Although this is valid even for technical indicators, but more so for high frequency trading, because high frequency trading, the volatility picture keeps changing very frequently. So unless you have the complete picture or the unless complete order book data, whatever information or whatever algorithm that you have built, it is very specific to that particular broker for that particular time. But if you build a technical indicator, the OHLC data will be same for all the brokers, right? That won't change. Online participants, is everyone facing the issue with the file? You are not able to download it. You can't find it on the exchange. I mean, sorry, the LMS. You can't find it on the LMS. Have you? You are not able to place this in class file. Okay, Akshay, I think MMT 03. I think Akshay has found it under MMT 03. Kapil, can you please look? Okay, you won't be having anything beyond column F. You will have only A, B, C, D, E, 5 columns. So that is fine, Ahmed. Yeah, only E column. The rest of the algorithm I'll explain. You can build it later, and the support team will share the information with you after the lecture. So you will have up to E column, A, B, C, D, E. That's it. This is the order book that you actually get from the exchange. Okay, that only that data is shared with you. So does everyone have this, or should I wait for you guys to download it and open it? Okay, Kapil, try and please download it on MMT 03 on LMS. How did you guys download it if it is not there? I mean, Kapil is saying it is not there. Rahul, you are there?
Yes, Varun. Yeah, tell me.
Can you please share that file with the participants?
All right.
MMT
The
03
bid ask file.
bid ask file.
Okay, sure.
Thank you. Okay. Okay, Kalpesh and Krishna are saying it is there in the MMT lecture details. Anyway, I have asked the support team to share it with you guys. So Kapil, you will be getting it in few minutes. The support team will send the mail.
Varun, just sorry for the interruption. The thing
Okay.
is like we have already shared the practice file with the students in
Okay.
MMT03, right? So as discussed, this tick by tick data file should be shared right now.
No. The raw file that
Yeah,
has
it has
only that.
already been shared. It is like MMT03. It's the file name is the
That's
zip
it.
file.
That is all. That is all that needs to be shared.
Yeah.
So the support team says that it has already been shared. So Kapil, please check the mail and thank you, Sunit. I think Kapil, you will have to download it, or else it's okay, fine. Just listen to the lecture. Okay, you will understand the logic, then you can implement it later. Okay, I'll share this file personally after the class. Okay, is it okay with you guys? Shall I move ahead? Okay, fine. So here you like we'll first try to understand the data or the information that we can see here. So we have the timestamp, okay, and we have the bid price, ask price, and ask quantity. These are the 5 columns that you have. So let us understand one by one. The timestamp you can see is very different from what we see on OHLC, right? Normally OHLC is not this way. You have clear hour, minute, second, days, years, and so on and so forth. But here you have some massive number, and this basically is a timestamp in Unix epoch timestamp. It is called as Unix epoch timestamp. You'll have to convert it in, okay, back into our normal so you see, if I press it, then you will see that the timestamp is Saturday, September 1, 2018, so on and so forth. So if I make it all zeros, you will get the timestamp of that particular day. It says Thursday, October 3rd, and the time. Right, one more zero. It says July 14, 2017. So you can copy paste what is there on the Excel sheet and type it here out and just press this, then you will be able to see the time that is being shown on the timestamp. So just by using this integer value, you can actually check what time it is. So instead of typing out the entire hours, minutes, and seconds, we will just be provided with a single integer that is representative of the entire time or the timestamp. Understood what this is? How to convert it in? This will be increased incrementally by 1 or 2 depending on the time at which the order actually comes in. So this will help you not making any conversions back and forth. If the timestamp is increasing continuously, then you can say that okay, my sequence of events is in that order. So that helps you in fast coding and everything. So coming back, this is bit quantity. That is the amount of volume that is there on the bit side. So here I think this 25, here is the bit quantity at this point of time. So what we see here is basically a representation of that. And then we have this bid price, which is similar to this price 1.3353. And then we have ask price, which is 0.87691, which is similar to this 1.3356. That is the ask price. And we have the ask quantity, which is 25, which is similar to 15. Okay, is it clear to know what it is, what the 5 columns are? Online participants, if you are not able to understand, please let me know or I'll move forward. Yes, Kalpesh, that is for one single day. This is L1 data. As you can see, we have only the best bid and best ask, right? So this is L1 data from LMAX exchange. It is one of the smaller exchanges of UK. It's for one day. Yeah, the timestamp is same. I just put it there to explain it to you how the HFT actually looks like. So I just put the same timestamp everywhere. You can vary it nevertheless. Actually, the timestamp will be different for every single entry in the order book when you take the real order book. Online participants, is it clear? I'll explain the reason why, but what happens is like the high frequency data that you see is not, we don't have the rights to distribute it and we don't have the rights to publish it unless we have an authorization from the exchange. So this is one of the free data that we got, we are able to get our hands on. So this is something we can work on and build a model, sample model, high frequency trading model. Okay, so there are, I'll just briefly explain what I do. What I'll do is I'll take the, in this, in this model, I have taken the same data for building the model and also to make a prediction. But when you do it in real life, you take the past data or the past 15 days of order book information, build your model, then apply it on the current day. You don't take the current day's data and train on it. For example, when you take an RSI, you will be using the past 14 minutes data or 14 days data, right? Here, we won't be looking at that. We won't be looking at the how past 14 or 5 or 3 or 2 or 1 uh, ticks data has performed. We are not going to do that. We are going to take how the order book has performed in the overall sense. So when you actually build a model, I think we have shared two Excel files. One is practice file, one is in class file, right? So ideally, I I would suggest that if you are very interested in building a high frequency model, you train or you build a model on one data and test it on the other. But here for convenience, I'm using the same sheet so that it will be easy to explain for you. Explain it to you. Okay. Online participants, you are able to understand what I'm saying. Here I have used the same data for training and prediction. But when you do it, okay, please use different data. So excuse. So it is like in sample and out of sample data. Yes, exactly. But here, as you see, the Excel sheet is so huge. I had to use the same Excel sheet because if I open two, it can get easily hanged, and I don't want you guys to face the same issue. So anyway, going forward, uh, our model is basically built on dividing the data into quartiles. So what a quartile is, basically we split the order book information into different parts based on the volume. Okay, so I'll draw and show you guys. Just bear with me for a few minutes. Okay, so let us say this is our x-axis and this is our y-axis. And what I do is I'll count the number of instances where the bid volume, let us say this is bid volume. Okay, I'll count all the number of times where bid volume was 1. That is, there was only one lot, and I'll get say probably some 10,000. Okay, then I'll count all the instances where there were two lots on the bid. So probably it was something less. Then I'll check for 3 and 3 will be say probably more. So I'll basically build a distribution of all the volumes on the bid side only for the bid. It will look something like this. Okay, then I'll split this data into 4 parts, like 4 parts such that each part has equal number of observations. That is, it has some 20k observations and all of them have 20 20 20 20. Okay, is it clear, online participants, what I'm trying to do? I split the data into 4 parts of equal equal number of observations for the bid volume. Have you understood it till now, online participants? If you have any doubt, please ask me now. So when I split the data, so I will get the volume corresponding to this split. which is first quartile Q1. This is second quartile Q2, Q3, and Q4. Okay, so I know the point or the price, the volume at which the lower 25 percentile data is separated from the higher 75 percentile data, right? And similarly, I know these two, the boundaries of Q2, second quartile. I know the boundaries of Q3, that is the third quartile, and I know the boundaries of Q4. When I split the data into four equal number of observations, four equal observations, I know the boundary conditions or the bit volumes that separate the lower 24 percentile observations, the 25 to 50 percentile observations, 50 to 75 percentile observations, and 75 to 100 percentile observations. Okay. The reason why we do this is we want to study the behavior of the algorithm in these four different quartiles. So first we have to build this data. Okay, we will try to do that now. Okay, online participants, any doubts, please ask now. If you want me to explain again, I'll do it. Any questions? You guys able to hear me? In class participants, you guys there? Online participants, anybody? Yes, thank you. I thought you guys left or I got disconnected. So you understood how we split the data, the bit volume into four parts. You will count all the observations for, each tick that we have, each volume that comes in. Yes, you have four different equal parts of the entire observations that we have. So here, if you see, B stands for bid, A stands for ask. Okay, so 0 to 25, that is 0 lots to 25 lots is my Q1, that is first quartile, where I have 25% of my observations, bid volume observations. That is any volume that comes between 0 and 25 will come in the Q1. Yes, we have used a formula. You can see it here, percentile dotting for first 25 percentile. Can you see it, Srivatsan, here? Cool. So you have this 25. Similarly for ask, I have lower 25 percentile volume, and the second half, that is quartile 2. Quartile 2 is between 25 and 50 lots. But you see that the interesting thing is quartile 3, it says 50 to 50.1. So can any one of you tell me how did I get a decimal? So I'll explain. So what you are seeing, hello, can you guys hear me? Online participants? Okay, thank you. Srivatsan, please check your connectivity. I think others are able to hear me. Thank you for the response. So here we have a decimal. So the reason why we have a decimal here is what we are looking at is basically not lots. So we have a multiple of 1000 in place. So when we see 0.1, that is 0.1 into 1000. That is, you have a 100, what do you say, 100 stocks or 100 dollars of order, worth of order. So it's a multiple of 1000 that you are looking at. Online participants, you understood why there is a decimal value? Okay, so I'll explain again. So What you are seeing here is the bid and ask quantities. Yeah, I'll explain. So the bid and ask quantities are basically not the lot sizes. They are multiple of 1,000 lots. They are just reduced down to size. So if I place 1,000 lots, okay, so it will be considered as one. So if I place less than 1,000 lots, it will be given as a decimal value. Iftikhar, is it fine now? You understand why there are decimal? Good. Akshay, you understood why there is a decimal? Because we are taking 1,000 lots as one. Okay, good. Nathaniel, is this formula same for all quartiles? Yes, I have used the same formula. I just changed the 25 percentile to 50, 75 and 100. Nathaniel, is it clear? It's the same formula for every 25 percentile increase. So by looking at this, you can make a small inference that mostly the amount of volume that you see on the bid falls between 50 to 50.1. That is 50% of the time you have 50 lots on the bid. Is it correct? Is my observation approximately correct? Online participants? Yes, sure. I'll explain. So you have Q2 or the second quartile being spread between 25 lots and 50 lots, right? And third quartile between 50 and 50.1, right? So basically my entire third quartile is close to just 50 lots. So 25% of the time I can say that I'll have 50 lots on my bid side. Something close to 50 at least, 50 to 50.1, right? Sunit, you are able to understand how we got that information? You are most likely to see a 2 lot value. 2 lots, I mean 50 lots, sorry. So you'll see 50 lots on the bid side mostly. And the maximum value that we have seen in this data is 450 on the bid side. That is probably when the volatility is very high or at the time of closing. The best bid has gone up to 450 lots. So we have minimum of 25 lots best bid and a maximum of 450 lots. All clear? Online participants, any questions? Yes, Sunit, you are correct. Similarly, we perform the same analysis for ask. So ask has 0 to 25 in the first quartile, 25 to 50 in the second, 50 to 75 in the third, and 75 to 350 in the fourth. Same formula, but for ask values, column E. Okay, this is ask quantity. Online participants, is it clear? If you have any doubts, please ask now. So, okay, good. I'm moving forward. So what we do is here we calculate in this box the amount of instances. Okay. Okay, Nathaniel is saying if the large quantity bidded for the same price, then it will be spread in Q1 to Q4. I did not understand the question, Nathaniel. So you are saying if there is a huge quantity at any given point of time, it will be in Q4. Yeah, that is true. The distribution is basically on volume, not on the time or price. It is just the volume data. Yeah, right. The minimum value for bid quantity is 0.1. This I think we can change it to safely say minimum of B to B, right? That should be right. Uh, oh, so the Excel sheet is so huge that it has gotten stuck. I'm sorry, it's about 85 GB, I think 85 MB or something. I should have manually changed it. Okay, so we got point one, and for ask also, I think it is point one. Okay, is this cool, Rohit? So the data level is L2 or L1. So Kalpesh, you tell me, is it L2 or L1? Anyone? Online participants? It is L1, right? So coming back to your question, Nathaniel, you are saying if I place 500 quantity, then will it be divided in Q1, Q2, Q3, 4? No, no. The 500 lots that you place at a single instance, right? That will directly go into Q4, right? 500 is more than 450. If you are counting, separating the data into 4 parts, it will fall under the highest category, Q4 category. You are able to understand? Nathaniel, are you able to understand? No, no, no. We are not taking price into account. See, here the formula you see percentile link of the column B, 25 percentile for column B, and column B is only bid quantity. We are not taking the ask bid price at all. If you place 500 lots in small lots, okay, we will consider a single tick or the single amount of volume that you put. So if I put 10, 50 lots, it won't be considered as 500 lots. It will be considered as 10, 50 lots. But if you put all the 500 in the bid side, then it will be considered as 500. That is, we'll consider that instance where the best bid is actually having 500 lots. Are you able to understand what I'm saying? We are checking the bid volume, okay, all the bid volumes that we have, and dividing them into 4 equal parts. 50.1 is the separation between 50% to 75%. So as I explained here, so probably our distribution is very close. This 2 and 3, this is only 0.1. The difference between 2 and 3 is very small. So your data could look something like this. You could look and 50 is all here, and then again the quartile 3. So we have Q2 and Q3 in the same distribution, very close. Yeah, Q1 here and you have Q4 here. So 50.1 is this value and 50 is this one. Online participants, Nathaniel, you understood what 50 and 50.1 are? I have data, bid volume. I count how many times or how much volume is there for each instance. Okay, so starting with the lowest volume that we have, that is 0.1. I'll count the number of instances that 0.1 has appeared on the bid. So let us say that I have seen 0.1 on the bid like 10,000 times. I'll make a note of it. Then I move to the next. Then I see that 0.5 is the next higher bid side volume. Then I count the number of times on the order book I have seen 0.5. Okay, I'll make a note of it. So similarly, I keep moving forward until I reach the highest volume. And in this case, the highest volume is 450, right? And once I have noted down all the volumes, I try and divide it into 4 equal parts. Is it clear? Online participants, you guys able to understand? Any of you having any doubt? No. Our quartile separation is equal. So all quartiles have equal number of observations. We are dividing the number of observations, Srivatsan and Kalpesh, Nathaniel. We are dividing the number of observations. We are not looking at the price right now. We are only looking at the volume. That is, you remember, I asked you a question. If I say that the best bid has 450 and best offer has only 5 lots, you said the market will go up, right? How did you say that without knowing the price? I asked you a question at the beginning of the class. I only told you that bid volume was 450 and the offer volume was very less. All of you said that the market was going to go up. Did you look at the price? If I change the market from crude oil to Euro USD, would it have changed your prediction? You are only looking at the volume. You are not looking at the price. When you are making a prediction based on order book, you see if the bid volume is huge compared to the ask volume, then the market is going up. Nathaniel, you understood? The order book movement is irrespective of the price. If I change the market, my volume behavior should not change. But of course it will change because every market has its own order book dynamics, but ideally it should not. So what we are doing is we are counting the number of times a particular bid volume has appeared. That is all we are doing. Srivatsan, understood? Have you understood? Kalpesh, Nathaniel, you guys able to understand what I'm trying to say? We are only counting the number of times a particular volume has appeared, and we are saying, and then we are dividing those observations or the number of times these volumes have appeared into 4 equal parts. That has to be coded using C++ Rivatsan. I know that it is very fast, they keep changing, but you have C++ at your disposal which is equally fast. So we don't train the algorithm while executing it. It won't train. You already have the trained algorithm ready. So whenever you have a bid ask scenario, it will just execute. Okay, shall I move forward? Guys, Srivatsan and Nathaniel. Okay, sure. So we have the bid and ask. We have divided equal number of instances into 4 quartiles. Okay, 25 percentile, 50 percentile, 75 percentile, 100 percentile. So we have got the volumes on the bid side that separate every 25% observations, 25% observations. So we have many 50 bid volumes. We have less. You can say that the distribution is very scarce as we go higher. That is from 50.1 to 450. We have around 25% of the data distributed there. Similarly, for ask, we have the lower quartile, that is from 0.1 to 25. We have the first 25% of the observations. Then 25 to 50, you have the next 25% of observations. Then 50 to 75.1%, we have the next 25% observations. Then 75.1 to 350.1, we have the final 25% observations. So what we do is we'll count the number of instances where bid and ask are in a particular quartile. So what we do is here B stands for bid and A stands for ask. Okay, so these are bid values and these are ask values. So if I say that there are 93,994 observations, it means that when ask volume was in Q1, and bid volume was in Q1. There are 93,000 such instances, 93,994 observations where bid and ask quantity are in Q1. So if you look at it, here the volume is less than or equal to 25 in bid and ask less than or equal to 25. So this is basically Q1 for bid and Q1 for ask. So we'll count this as one of these instances where bid and ask are in Q1, right? And here if you come, here the bid is Q1, that is less than or equal to 25, and ask is 50, which becomes Q2, right? If you see, Q2 has 50, 25 to 50 goes to Q2. So it will be counted as bid in Q1 and ask in Q2, this one. You guys able to understand how we counted all those instances? Online participants, if you are not able to understand, please ask. Nathaniel, Srivatsan, Darshan, you understood how we got Q1 and Q2 values, and now we are counting the instances where bid and ask are in Q1 and Q2. Okay, Farooq, I will repeat again. Okay, let us see by example. Let us go by example. Let us take this. Here the bid quantity is 25, right, Farooq? And ask quantity is 50. So bid quantity is in Q1, that is, it is between 0.1 to 25. Less than or equal to 25. Equal to is there. So when it is less than or equal to 25, it will come in Q1. And here it is 50. So 50 less than or equal to 50, it comes in Q2, right? I'll just make a mention of this. So now you can see that 50 comes in Q2, 25 comes in Q1. Farooq, you are able to understand how we got this, how we counted all these observations here. Bid in Q1, ask in Q2. So bid in Q1 and ask in Q2. Here we'll have one observation. Similarly, when we move to the next, here we'll have another observation. Bid in Q1, ask in Q2. So here we'll increase the number to 2. And again in the next instance, you have bid in Q1 and ask in Q2 again. So that will come on this one. Again, we'll increase it to 3. So similarly, we count all observations, okay? And we'll make a note of the number of observations where bid and ask are in Q1, bid and ask are in Q1, Q2, Q1, Q3, Q1, Q4, and similarly Q2, Q1, Q2, 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 Q3, and so on and so forth. You understood how we are counting? We are looking at the bid volume and ask volume and deciding where they belong. If it is Q1, Q1, we'll increase the instances by 1. If it is Q2, Q2, we'll increase it there. So similarly, we'll segregate the bid volume instances into different parts, and then we'll make a note of those observations. And answering your question, Kalpesh, you are not expected to fill this in the Excel sheet. No, just follow and understand what I'm doing. Okay, you don't have to copy paste the code and all. I'll give this Excel sheet after the class. Excuse me. Farooq, you are able to understand? Okay, so you understood how we got this entire count. Would there be double counting? No, actually all the timestamps are different. So all instances are different. There are, if you see this and this, there will be some change in one of these 4 columns. So only then we'll make an entry in this order book. So you can see that this is different, this is different, this is different, so it won't be the same. The timestamp will never be the same, Darshan. Here I have just shown an epoch timestamp for example, but in reality, the timestamp will never be the same. They will be up to nanoseconds. So there will be difference. and if there are two similar instances, it will be counted as 2, not 1, since the timestamp will be different. Let us say that you have 25 bid and 25 ask in the morning once, right? And again in the afternoon you see that there is 25 bid and 25 ask. You also want to know how the market has moved in the afternoon, because morning behavior might be different and afternoon behavior might be different, right? So you count both the instances separately. Have I answered your question, Darshan? Even if the timestamps are different, even if they are different, then you'll have to count them as two different entities. And the granularity of the timestamp should be very, very low, ideally in nanoseconds. If it is less and you are getting similar timestamps, then it means your data is not really that good. So okay, now what we'll do is we have counted the number of instances, okay, where bid and ask belong to a particular quartile. Now we will understand how the market has behaved in these situations. That is, when the bid and ask are in Q1, then what happened? Has the market gone up or down? To make that calculation, what we do is we calculate the mid price. Okay, we track the mid price move and we see how the market has behaved. So mid price is nothing but the average of bid price and ask price. In this case, there are many different types of mid prices. We'll get to that later. But in this case, mid price is basically the average of bid price and ask price. So when the mid price moves to the higher SI, an issue, Rohit, probably you'll have to unplug and plug in and try again. Okay. So, okay, good. So as I was saying, you understood what mid price is? You guys, you are able to hear me? Mid price is basically to track the movement of the bid and ask. So whether to understand whether the bid and ask have moved upside to the, or to the downside, we'll take mid price as the reference point. So if the mid price has moved up, okay, the signal will be 1, and mid price has moved down, then the signal will be -1. So for example, in this case, here the mid price is 876265, here 87627. So mid price has gone up, right? It has increased. So my signal will be 1. That is, given this bid and offer volume, my mid price has moved up. That is what I'm trying to predict. So if I look at this mid price and bid volume and ask volume, I should be able to understand the signal. I should be able to predict the signal. That is, the next movement will be higher. That is, the mid price is going to go higher. Online participants, you are able to understand what we are using the mid price to generate a signal, and what that signal will be, how we are going to interpret the signal using the bid and ask. So as someone earlier pointed out, the bid and ask prices, if they change, we don't have to worry, the calculation will be the same. The sell signal here. So the sell signal is basically when the mid price goes down. So if my mid price has decreased, it will be -1, else it will be +1. So I calculated my mid price, that is my bid volume and bid price and ask price. It is the average of bid price and ask price. You check the formula here. and I track this bid price and ask price. So let us say that when my bid and ask were so and so, and in the next instant or the next tick value, tick movement that has happened, it has happened to the lower side. That is, my mid price has decreased. So we are trying to say, we are trying to link the bid volume and ask volume to the movement of the mid price. So my mid price can go down in two ways. That is, either the bid price can go down or the ask price can go down. Either way, the market is moving down, right? So when I have a scenario where my bid and ask were in Q1 and Q1, then the next signal has happened to be -1 in this case. So you're saying if an order is filled, then automatically there will be a change in the bid and ask price. Then mid price will also change. Yes, that will also be a part of the order book data. So when your bid price and ask price are hit, so the market volume will move to the higher side. So we are looking at the future price to make a prediction. We'll be training the model based on this. So we are trying to ascertain the future movement of the market based on the current bid and ask volume. That is what we are doing. Based on the current ask, current bid volumes, I want to see how the market has behaved in the past. That is, if I give you the bid and ask volume and I'll ask how many times has it gone down yesterday and how many times has it gone up, you will be able to make that calculation using the signal now. So the signal, you can count all the signals and say, you can tell me that, okay, in the last 3 days, okay, whenever the bid and ask were in Q1, the market has gone up like 50% of the time and it has gone down 50% of the time, right? So the signal will help me tell you, help us in understanding how the future movement is going to happen given the current situation of the order book. Yes, no, most recent is at the bottom. This is the market opening price. The market has opened here. So Srivatsan, will the market volatility caused by stock specific and market specific news be temporary compared to historical data analysis that we are doing over the long term and short term as well and trading? Okay, I'll one second, let me read it. So you are trying to compare some news event to historical data analysis. So it is very hard to say anything in general, Srivatsan, but I think temporary nature of volatility shocks or intraday moves are very limited. So they are temporary in nature. Effectively, what you're saying is correct, but it is very hard to generalize how the movement is going to be, or the volatility will affect intraday, and it will depend from case to case. Uh, will the fundamental analysis that we are doing be more long lasting than the temporary volatility? We are not using volatility here in the model. We are just using the analysis of the order book, not a fundamental analysis. We are just checking the order book information and making a prediction. No, Rohit, we are trying to predict the future. So we cannot take it lag by one. If we take a lag, that means we are checking for what has already happened. So we want to check for what is going to happen. So here the -1 indicates what has happened in the future. That is, the next mid price move is to the lower side. So given an order book, what is going to happen? That is the question we are trying to solve. Given the bid volume and ask volume, what has happened? You are able to understand? When my bid and ask were in Q1, it has gone down. Here, it has gone down. Here, it has gone down. Here, it has gone up. and again here it has gone down. Thank you. Okay, so now what we do is we will calculate the instances, okay, where bid and ask are in Q1 and the signal is 1. Okay, that is the market has mid price has moved up. Okay, we will calculate only those instances where the mid price has moved up for a particular quartile scenario. That is, here you see the market is in bid is in Q1, ask is in Q2, right? And the signal is 1. That is, market has gone up. Okay, can you guys hear me, please? Let me know. Rohit, Srivatsan, you guys able to hear me? Okay, thank you, Marcelo. Thank you, guys. So, Srivatsan, you are saying so this model is mainly to make profit using 1, which is buy signal, and -1, which is sell using algorithm. Yes, yes, you are right. We'll get to that, but still now we are in the formulation stage where we are trying to understand how to do it. Once we finish, then we'll apply the algorithm completely. Okay. And ideally, I think someone has asked me whether you should do it on Excel sheet or not. Ideally, this coding should be done on C++, which is the fastest way to execute. Since every tick happens in like 30 seconds or 40 seconds, sorry, 30 microseconds or something like that, you'll have to be very, very fast. Python, people are, and the industry in general is not in favor of Python. Python is good for slightly higher frequency, sorry, lower frequency like 1 minute or 1 second probably. 1 second is also fine. But going into micro level, you will need C++. C++ is useful only for HFT. Java is also a very good option, but I believe C++ gives you the fastest execution. Java is also very good. It's faster than Python, but it is not as fast as C++. Okay. So let us go to the next part. See here the Q1 and Q1 are there. So I have counted all the signals where the bid and ask are in Q1. So bid volume is in Q1, ask volume is in Q1, and the signal was 1. So 47,000 times approximately I have instances where bid volume is Q1, ask volume is Q1, and the mid price has moved to the higher side. Okay, similarly I have calculated for Q1, Q2 and other scenarios. You guys understood how I got this? I have added just one more condition to this. Yes, I will share, Channon. I'll share this file after the lecture. So here you see the criteria has just changed by adding the signal column to it. That is, the signal should be 1. So I'm counting all the instances where bid and ask are in a particular quartile and they have moved up. So in an essence, I tell you that yesterday 50,000 times when the bid and ask are in Q1, the market has gone up. Okay, and the total number of observations is 200,000 of bid and ask being in Q1. So can you tell me what is the probability? The total instances combine both +1 and -1. Here only +1. Here we have calculated all Q1 and Q1, right, Kalpesh? Here we have calculated Q1 and Q1 and the signal is 1. Yes, Sunit, Darshan, you guys are right. It is 25%. The answer is 25%. So you guys understood here the Q1 and Q1 of total number of instances, how many of them belong to Q1 and Q1? Okay, that is what this table says. And this table says if the volumes are in Q1 and Q1, then how many times has it actually gone up? So I know that if my bid and ask are in Q1 and Q1, then my probability of market or the mid price going up is 47,000 divided by 93,000, right? That is the probability of going up when the bid and ask are in Q1. So out of 93,000 times where bid and ask were in Q1, 47,000 times the market has gone up. So the probability of market going up when it is in Q1 and Q1 is 47,000 divided by 93,000. Anybody has any doubts? Iftikhar, Ahmad, Suneet, Kalpesh, Darshan, any of you guys, Chanin, Nathaniel, Srivatsan, you understood how I got the probability? I just divided it. Good. So once I have the probability, now I see that highest probability where do I have of the market going up? Here, yes, only demonstrating the probability of buying. The probability that when the bid and ask volume are so and so, okay, what was the probability of this market going up? What is the probability of market going up? So here, when the bid is in Q3, ask is in Q1. That is, bid is very high and ask is very low. Right? Q3 means it is very high, Q1 is very low. Signal -1. How is it signal -1? I think I mentioned it as signal equal to 1. Here. You guys able to see this? Online participants. Should we also calculate how much it has gone up in each scenario and then multiply it by probability? That is a complication that you can take up later, but right now, as you can see, the Excel is hanging only for the single -1 and +1 gap. This is to just to give you a brief understanding or intuitive insight into the high frequency trading. This is how the calculation is done. You can definitely make it more complicated. You can take simple moving average of all the past signals and then hold on to the position, or you can do whatever you want. Anyway, let us get to that. You can make your own changes. That is why I have given you the other sheet also, practice sheet. You can try whatever you want on that. So Krishna, you're saying selling probability would be -1. I don't get you. Selling signal is -1. Yes. Buying signal is +1. Yes. So going back to this, you have the probabilities. You can see that maximum probability of going up is 63%. That is when the bid is in Q3 and ask is in Q2, right? That is when the bid volume is between 50 and 50.1, ask volume is between 25 to 50. That is when we have the highest probability. So let us do one thing. Let us build a small model and see how it goes actually. So here I have calculated the signal, and here I have calculated the bid quartile, that is the bid volume, in which quartile does it belong. Then I have calculated the ask quartile. Then I got the probability from this probability table. Okay, so when bid quartile and ask quartile are so and so, what is the probability of going up? So to evaluate sell probabilities, the change should be to -1. Yes, that is correct. But we don't have to do it actually. If you know the probability of going up, 1 minus that probability will be the probability of going down, right? Okay, so you guys understood how I got these three signals, three columns. I have just taken this bid quantity, cross-checked with uh, this table, and I have assigned the bid quartile to it. Similarly for ask, so when bid is and Q are in, thank you. You have bid and ask in Q1 and Q1, then what is the probability of up? This I have got from the probability table. Well, I can't take credit for this algo. This is not my algo. It is one of the research papers presented on SSRN. So I have used the same research paper. So I have bid, ask, and probability. So when we do a high frequency trading, we have to keep in mind the spread value. Okay, spread is basically the difference between bid and ask. So if your bid and ask spread is very huge and it is more than your stop loss, then your stop loss is going to get triggered, right? So in general, when we do high frequency trading, our stop loss or take profit will be in terms of couple of ticks. That's it. So if your spread is much more than the take profit and stop loss, you should ideally not trade until the spread becomes narrow for you to put your orders in. So keeping that in mind, if you see this tick size here, column W and X, I have taken a take profit target of 5 pips and stop loss target of 5 pips, okay, and a lot size of 1, and I have taken the tick size as fourth decimal, okay. So based on this, I have calculated the spread by subtracting the bid price minus ask price divided by the tick value, okay. So I get around a spread of 9 ticks, 8 ticks, 6 ticks, 7 ticks. So as you see, the tick, the spread size is decreasing. That is the difference between the bid and ask is decreasing, because at the opening of the market, you have much wider margin between bid and ask. And as the market starts to trade and more volatility starts to come in, you see that the spread narrows. So that is what we are seeing here. What would be the trading volume if the not enough volume? Sorry, Krishna, I'm not able to understand what you're saying. What would be the trading volume? Trading volume to fill the order. So our lot size is one lot. So we are assuming that we will get a fill, no partial fills. So the spread is in tick size and not the actual bid ask. Yes, that is correct. Our order. That's it. Yeah. So I think we have finished 2 hours. You guys want a break? Shall we go ahead after the break for 5 minutes? Shall we take a break? Okay, we'll take a break. Rohit, I'll answer your question once I come back. I'll come back and check. Okay. Thank you, guys. Okay, so you guys back? Shall I start? Shall I wait for a couple of minutes? So till then I'll try to answer the question. Rohit, you are there? So I have changed the bid and ask values to 0 here. So I guess in the ask side, there are values less than zero point 0.1. I had taken 0.1 for convenience, right? Because the Excel was getting stuck. So once I changed it to 0, then I got a value very close to total number of data points. That is 710,749. So I have one data point less, and you're saying that it should be 94095. So I believe it is probably because of the signal criteria that I have used here. Greater than GG84. I think if I remove this, it should be fine, I guess. Sorry. Yeah, I guess now it is rectified, right? I had included the signal criteria. I think somewhere the signal is equal to 0, one place. That is the bid ask has not moved actually. The bid price and the ask price probably moved equally or something like that, and the bid value is the average of both of them is remaining constant. So that I have not taken into account. Here I had unnecessarily included it, so we have a small variation. Is it clear, Rohit? Anyone? So shall I start? Shall I move ahead? Guys, Krishna, Sunit, you guys are there? Have you come back? Okay, I'll wait for a couple of minutes and I'll start. Okay. Okay. Yes, that is fine, Krishna. We can take the question after the lecture. Not an issue. So I'll start now. So till now we have understood how we got up to column J, and we understood how spread is calculated. So to repeat again, how spread is calculated, spread is the difference between bid price and ask price. But since our take profit and stop loss are in terms of ticks, I have converted the spread also into ticks, right? So I have converted the bid minus ask, which is in terms of price, to ticks by dividing it with a single tick value. So if I say the best bid price is 5 and best ask price is 10. So the difference between bid and ask spread is what? 5 cents. But let us say that my single movement in the market is 0.1. So between the bid and ask, I don't have 5 prices. I actually have 5 divided by 0.1, which is 50 prices. So I have 50 ticks between bid and ask. So I have divided the bid ask spread with the tick size. Okay. So I got the spread. Is it clear till now? Some of you have asked to explain the spread again. Online participants, Prakash Babu, I guess you asked me for that spread calculation. Is it clear? You understood why We have taken it in terms of ticks and not the price values. So okay, let us go ahead and calculate the signal. So signal is basically what? Uh, we generate a signal, that is an entry buy or a sell signal, whenever the probability of the market going up is more than 60%, and similarly the probability of market going down is less than 40%, or the probability of going up is less than 40%. That is, probability of going down is 60%. You guys understand what I'm trying to say? That is, if I have this probability matrix from here, if I get these two criteria, that is when my probability of going up is 60%, probability of going down is, sorry, going up is 63%. So whenever I have a bid and ask satisfying these two criteria, bid and ask volumes, I'll buy. And similarly, whenever the probability is less than 40%, okay, probability of going up is less than 40%, or in other words, probability of going down is 60%, right? So whenever the probability of going down is more than 60%, I will sell. So based on this criteria, I will generate a signal. So if we see here, let us see where we get a, yeah, we have a signal here. So here, if you see, we have generated a few signals. So we have a signal of one here where the probability is 63%, right? So we have a buy signal, but already an existing buy signal is there continuing. So we don't buy again, we just maintain the signal. The first time we get a buy signal, we check whether we already have an existing buy position open. If we already do have a buy position open, we don't buy, we just hold it. So here you see that we have bought long back when this probability was 63%, we are still holding it, right? And okay, I hope I'll be able to show you guys. Just okay, so we got it. So here I got a probability signal of 63% for the first time. So I got a signal of 1, okay, to buy. So in the next tick I will be able to buy, right? I won't be able to buy immediately at this price. I will be able to buy in the next signal only. So when I buy, I will be buying at the best ask. That is, the ask price is 0.8756 in this case. So let us see. 87554. So we rounded it off to 8756, I guess. So at this price we will be buying. Okay, sorry. And yes, in this case I have used the market order, but ideally you can use market order or a limit order. But if you use a limit order, there is no guarantee that you will actually get a fill. So limit order should be used when your probability is very high. In this case, our probability is 60%. So it's not ideal for you can say using a market order or a limit order. Ideally, because we actually taken this data from only one exchange, right? This is not a consolidated order book. So your market, whether it is going to go up or go down, the probability is not showing up very high. If you take a consolidated order book, I am sure you will have much more granularity in the data, and also you'll have much better probabilities also. The probabilities can go up to 80% also. If you have consolidated order book, I have seen that probabilities go up to 80%, and then you can be very sure that the market is going up. Then you use a market order, right? But if your probability is low, then it is better to use a limit order. Okay. Okay, this is basically the stop loss values. This is the take profit, this is the stop loss. So this is where we have entered the trade. So 5 ticks below this we will get this price. 5 ticks above this, you will get this price, right? 5 ticks converted by single tick value, I have subtracted and I got this stop loss and take profit values. So whenever my bid and ask prices hit this price, these prices, either take profit or stop loss price, I'll book my trade accordingly, whether it is a stop loss trade or a take profit trade. Okay. So for every entry, at the time of entry, I take the take profit and stop loss by subtracting the TP and SL. Is it clear, guys, how I got this? I take the entry price and I get the take profit and stop loss. So going down, whenever my uh, it is triggered, let us see where it is triggered. Oh, we have held it for a very long time. Although it looks like a long time, it's probably less than one minute or 30 seconds, something like that. Because for every second you have around 30 to 40 entries. And my exit criteria is like whenever stop loss is take profit is triggered, only then we'll hit. Since it has not been hit anywhere, 5 ticks it hasn't moved to 5 pips. So we have held it for quite some time. Okay, finally have it. Okay, so here we have hit our stop loss. Here the price has gone below 8750. See, here the price has gone below, so we have closed out our position. We assume that we have closed out our position at the stop loss price, and we had booked the 5 ticks loss. So this is just an approximate way of showing you how an HFT algo works. Ideally, it should be done in programmatically, not on Excel sheet, because as you can see, it gets stuck. So when the next signal is generated, again I go long, I calculate my take profit and stop loss, and wait till the profit or stop loss criteria is triggered, and then I book my loss, profit or loss. Okay, and I make a point to note it down. You guys understood how this algo is working, how this model has been built? So Krishna, you're saying, but if we are using derivative futures, we only have one market data and not. Yes, for futures data, you will have only one, but this is not a futures data, right? For stock data or something like that, you will have multiple data. For futures, okay, I agree. But if you have different, it is a long only strategy because our the short criteria has never been triggered. The probability has never gone below 0.4, right? I'll show you. See here, do we have a short criteria? Do we have the probability going less than 0.4? The least is 0.43. So, yeah, so we don't have a less than 40% criteria, so it has never been triggered. Yeah, so effectively no short. We have only long signals generated twice, here and here in these two cases. So we have calculated the take profit and stop loss. We sum it up, we get the final return, and in terms of ticks, we have lost 30 ticks. So we have built a model, we have understood how it works, we have understood how to build signals, how to generate signals, how to make a probability model and all. So my question is, why did we lose money? You have understood the model, you have understood how it works. Tell me why we lost money. Because the probability seemed sound, very logical. So Kalpesh is saying it is because of the spread. Okay. How do we lose money because of the spread? Is it too low or too high or something like that? Farouk is saying slippage. That is a very good point. Yes. Exit criteria is not defined. That is very good. Volume has decreased. No, volume has not decreased. How did volume decrease? I mean, in what sense exactly you are saying volume is decreased? So anyway, we are using midpoint for the calculation rather than midpoint because spread is high because probability was for that quartile which changes as we go ahead. We haven't defined the time until we hold it. Yes, these are very good points. So first thing is we have to define a clear exit criteria. Here our exit criteria was basically take profit and stop loss. It should not have been that take profit and stop loss. It should have been like time criteria should be there, right? You can't hold it indefinitely. And also you'll have to define, do an extensive research. And most importantly, this is not a consolidated order book. Let us say that we got 60% probability from this exchange's data, but actually Euro USD is traded extensively on different exchanges in Europe and US. Probably there the volumes that are standing in the order book are different, right? So that is why our probabilities are completely wrong. It could be completely wrong. So you understand now what is the importance of a consolidated order book. We are only looking at half of the picture, but the price movement is dependent on the complete picture. You guys are able to understand? Our model is built on the volumes of one exchange, but price moves based on all the exchanges data. So we need to have a consolidated order book. Is it done? Shall I close this? Shall we move on with the presentation lecture? Yes, we have not taken brokerage taxes and other things into account. We have used market orders. So the ideal slippage would be slightly greater than that, what we have seen. So if you use a consolidated order book, there are two advantages. Your probability will be much higher because your granularity of data will increase. So your predictability will also increase and your repeatability will also increase, right? So what has happened day before yesterday or yesterday's data will be valid on today's data. But if you take a single market or single exchange, then repeatability will be a question mark. So shall I move ahead? Any more questions? Yes, Sunil, this is one of the fundamental HFT strategies. This is one of the fundamental strategies. You can definitely say that. Okay, so moving ahead. So you guys understood this? You can make as many variations as you want. So there is no hard and fast rule that you have to use this. This is just for your understanding to understand how HFT trades actually, how HFT firms work. So you can see that once we have arrived at the probabilities or the bid ask volume separation, all I have to do is just look at the stream of the data, check bid and ask volume, and see if it is greater than this and this is less than this, then buy. If it is less than this and buy more than this, then buy. Something like that. Just very small calculations, no big algos involved, no major complications involved, no standard deviations involved. It's just checking the volume and making a decision fast. The more variations you make, it will become more complex. Okay. So we have finished this model. We have bucketed and we have done all the quartile, everything. Now we'll move to the final research paper that we'll be discussing in this lecture. So this is basically a discrete Poisson model. That is, I'll explain it with the help of an example. Okay, you guys slightly pay attention. This is based on physics, concepts of physics. Let us say I have some water in tumbler, okay? And at any given pressure and temperature, there is some amount of water vapor that is condensing. And at the same pressure and temperature, there is a rate at which the water is getting evaporated, right? So if I know how much volume is here, if I know the rate of condensation and if I know the rate of evaporation, can you tell me how much time will it take for this volume to evaporate? Right? Online participants, can you guys tell me? It is basically C or E minus C is the net rate of evaporation, right? So V divided by E minus C will give you the rate at which then we'll, yeah, error in measurement and other things are there. Let us ignore all that and just give a basic outline for the model. That is V divided by E minus C will give you the time it will take for the entire volume to disappear, the water to disappear, right? So effectively, we can use the same technique for our order book. Let us say I have a bid volume of 1000, okay? And I have a rate of 50 orders per second coming in and 100 orders per second going out. So how much time will it take for my entire bid volume to be exhausted? Anybody can venture a guess? Online participants? Yes, Kalpesh, 20 seconds. So if you know that your bid is going to get exhausted in 20 seconds, and by similar calculation, you know that your ask will get exhausted in 10 seconds, then what do you think is going to happen? Then the mid price is going to go up, right? Because ask will go faster and bid will still be standing there after 10 seconds. Yes. So effectively, the rate at which the orders are coming in and going out also matter, and the rate at which, uh, I mean, sorry, the amount of order that is already standing also matters, right? So based on this model, we can build another model based on this theory, basically, that the arrival rate and the rate at which the orders are leaving on bid and ask, you can calculate the amount of time it takes to move market to move up or down, or in what time you can expect the mid price to move up. So based on that, you can stand in the order book at a certain depth and take favorable fits. So this is one of the research papers. I have just explained it with an example, although I'm not going into mathematics of this right now. We'll just uh, this is the basic intuition behind the model. That is, knowing the rates, you can make prediction about the mid price movement. One, we have seen the probabilities. We have seen that what the past bid price movement was, and based on that probabilities, we made a prediction and we built a model. Second is we have volume data, the rate at which volumes are coming in and going out, and you make a prediction based on that. Okay. Online participants, is it clear till now? Okay, fine. So moving ahead, you can see that we never got 100% movement. That is, even when you have this probability here, let us say here the bid volume is in Q4 and ask volume is in Q1. That is, bid is very high and ask is very low, but still our probability of going up is only 57%. Ideally, it should be a lot more than say 60% or 55%, but we just have it as 57%. Because the data itself is not consolidated, and two, when I explained the uh, spoofing, you remember in the spoofing we put a huge volume, and someone asked a good question that if we have a huge volume and someone comes and hits it, what will happen? So when you suddenly see a huge volume, that is Q4 level volume, then people try to test it. So there are many cases where the market actually doesn't go up, even though it is Q4 Q1, people will come and test the Q4 bid. So there are many instances where market actually goes down, even if it is Q4 and Q1. So knowing your probability based on the volume is very important. Online participants, is it clear why we have different probabilities and probabilities not as expected? So Okay, fine. So see here the bid is increasing, right? From Q1 to Q2, Q3 to Q4. But ask is in Q1. That is, it's not increasing that much. So ideally the probability of going up, the mid price going up should increase, right, Sunit? But it has not increased in this case. Why? The reason is maybe in other exchanges there was huge volume at that time on the ask side, right? Because it is not a consolidated order book, we cannot give a definitive answer. And the question is, and another point is, let us say you see a Q4 volume, that is some 400 lots on the bid, and ask has like 5 lots, right? Then we are talking about a case of Q4, Q1. But what happens is when you see such a huge volume suddenly, people might test it. That is, they will hit it with one lot or something and see whether that is actually a real volume or someone is trying to spoof them. So the mid price will go down, right? In that case, that is the movement will happen to the downside. So it is not as easy as you expect that when you have higher volume on the bid, it should go up. It doesn't happen that way because of human behavior and the incomplete data that we have. That is what I was trying to say. So moving ahead, we have discussed the transition rates. Okay, so coming to the mid price. So mid price, there are 3 ways of calculating the mid price. Okay, one is arithmetic mean, which we have already seen in the exercise. The other two are volume weighted mean and the harmonic mean. So let us go back to our example. So looking at this, can anybody tell me what the volume weighted mean is? How do you calculate it? Volume weighted mean will be 25 into 1.3353 plus 15 into 1.3356 divided by 25 plus 15. That is the volume weighted mean. Online participants understood how to calculate the volume weighted mean. So the mean would be closer to the side which has higher volume, right? In volume weighted mean, the mean will be shifting from the center, right, to the side which has more volume. So here the volume weighted mean will be closer to which side? Bid side or to the ask side? Online, guys. Bid. Awesome, very good. So here the volume will be, mid price will be closer to 25. Let us say that after some time this 25 has been hit and we have some 10 lots here. Then where will the mid price be? There is no ask here. The ask has moved to this point. Where will the ask, I mean the mid price be? It will be closer to which point? Yes. So the movement in the mid price is not continuous. It will be discrete jump. It will suddenly move, which will be closer to 25. It will suddenly jump higher to the ask side. Okay, Srivatsa, you are saying bid quantity minus ask into sell mean anything? I don't know. I haven't seen anything like that. So I really can't say. Probably you're calculating some sort of a differential mean, I guess. But there is nothing much to go on this. So you understood what geometric mean is or volumetric mean is and how the mid price behaves. Mid price will be closer to the bid or higher side where the higher volume is, and when the lower volume is getting exhausted, it will suddenly jump. Okay, that is how the mid price will behave when you take volumetric mean. If I take harmonic mean, what will happen? If I take harmonic mean, it will be 25 into 1.3356 plus 15 into 1.3353 divided by 25 plus 15. Right? That is how you calculate harmonic mean. That is bit size bid into ask volume plus ask price into bid volume, bid into ask size plus ask into bid size, divided by bid size plus ask size. This is how harmonic mean is calculated. So based on this, what can you say about the harmonic mean of this? Yes, Nathaniel, that is absolutely right. The harmonic will be closer to the ask, right? And as the ask keeps disappearing, Srivatsa, it can give you buy and sell signals, but we are not discussing that here. That can be taken up as a completely different research or some kind of different paper or model building. But yes, it can be used as a buy and sell signal. I agree, but I have to look into it because I have never worked on such a thing. So I'll have to work on that and tell you how it works actually. So online participants, have you understood how harmonic mean works? If you have not understood, tell me please. It will work in the opposite way of volumetric mean. Okay, because we will be multiplying the opposite sides. Okay. In volumetric mean, we multiplied the price with the volume, right? Here we'll multiply bid volume with ask price and ask volume with bid price. So effectively, we are shifting the mid price to the side with the lower volume, right? The volume, wherever the volume is less, the harmonic will be closer to that price. Uh, can we, Kalpesh, you are able to understand harmonic mean how we calculate? We take 15, which is the ask volume, and multiply it with one bid price, and take 25 and multiply it with ask price, and divide it by sum of ask and bid price. Yes, I'll explain why. So when you do this, your harmonic mean will be closer to ask price. So when ask is getting exhausted, it will move continuously. It won't take a discrete jump like volume weighted mean, which suddenly jumped, which was closer to bid, and suddenly it got exhausted, so it just jumped upwards, right? Because the next task has come into picture. But in the case of harmonic mean, it will be closer to the lower volume, and the mid price will keep moving continuously in that direction. So from your understanding of volume weighted mean and harmonic mean, which of these two do you think is more indicative of the actual mid price? Yes, harmonic mean is continuous and weighted average is discrete. So depending on what type of algorithm you are employing, that mid price you have to use. Let us say that you are more interested in knowing where more support is or resistance is, then you use the weighted average, volume weighted average. If your algorithm works on the basis of least resistance, then use harmonic mean and you move in that direction and it will be continuous. Understood? Online participants, Kalpesh, Suneet, Nathaniel, any questions? If you guys don't have any questions, we are at the end of the lecture. We can close it up. I guess we are almost done. So just to briefly summarize what we have learned. We have learned what are the different types of order books, what are dark pools. We have understood uh, how we actually calculate the probabilities, probability matrix methodology using the bid ask volumes, how to distribute it into various quartiles, and we have learned how to see if the order book is useful or not. And we have learned about consolidated order book and the importance of it. We have understood the tick data, and we have understood the epoch timestamp, right? And we have understood uh, uh, what else? The spreads. We have understood how to calculate the spread, and we have understood how the mid price is and how to calculate the mid price. Okay. Any more questions? Anybody? Online participants or in-class participants? Anybody has any doubts, please ask. Yes, Farooq, I will share the final model. The support team will send a mail to you guys. The probability model, this one. Yes. So you have understood how I got these quartiles? You want me to explain this probability one? Okay, so you have understood how I counted all the bid and ask quartiles? You have understood how I calculated the signal one, like how many times it has gone up? So if I say that there are 94,000 observations total, where the market is in Q1 and Q1, right? And out of these 94,000, if I say 47,000 times the market has actually gone up, okay? Then what is the probability of the market actually going up when it is in Q1 and Q1? It is basically dividing this by this, right? That's it. That is how we get the probability. Okay. So approximate Sharpe of HFT models is around 30. We have seen models which have a Sharpe ratio of 30. So that is there. And Nathaniel, you are saying, I think we cannot apply this in the stock where the volume is less. Absolutely. We cannot use this. We'll have to have a different model for low liquidity models that are completely different. And any other question, guys? If I am trading in any option, ATM strike price and bid ask gap is always with a gap of 20 paisa in the formulation of price is on the underlying and Greek option calculations such as delta, gamma, and data. Okay, I guess this is related to option trading, guys. I mean, I don't have much idea, but I think if you are saying that the bid ask gap is very high, how do you trade it, right? If that is what you are asking. If the bid ask spread is very high, then it means the market is uh, what you say, it's volatile right now and the movement is very high. So we have to have two different models when the market is highly liquid and non-volatile, and the market is very liquid and less volatile, or sorry, volatile. So there are four total scenarios: volatile and liquid, volatile and illiquid, right? Then non-volatile and liquid, and non-volatile and illiquid. So for these four scenarios, you have to build four different models and see whichever is most profitable and only run it. Have I answered your question? Based on Greeks also you can build a similar model, like Greek scenario, how it moves. Yes, I agree that ATM calls and puts are always volatile, but I don't understand how we can apply this there, because here the model is completely based on the volume, bid ask volume, that's it. We are not looking at the Greeks, but we can probably discuss it. If you have any doubts exactly, you can send it to me by mail, because I'm not able to understand the options implication in this question. Okay, Nathan, if we are taking brokerage and taxes into consideration, then how and where do we set stop loss and take profit? That's a good question. But in general, if you take brokerage and taxes into account, the models that we build are not profitable. So if you are a market maker or a HFT trader, we generally have a discount broker or some kind of discount coming from the exchange directly. Okay, because we do a lot of volumes and give liquidity to the exchange will give you some kind of concession. So that is how we actually make a profitable strategy. The guys Vartu that I talked about in the beginning of the lecture, they make their profit or they are competitive compared to others because they get the best discount from the exchange. That is why their transaction cost is very fractional compared to what you as an individual trader pay. All right, any more questions? Anything that I have left answered, unanswered, or anything that you guys want to know? Okay, guys. Thank you. Thank you for an awesome lecture. Take care. Bye.